workshop in May, and glad to see some familiar faces. Definitely see a larger crowd. I think this is a really important and relevant workshop because it's focusing on not only on financial literacy, but capacity building. Because when we first formed this organization, Jason and I think the big issue was it's not just about facilitating opportunities. It's also about placing our members in positions to execute those opportunities.
Good evening, guys. Yes, really happy. I'm going to be honest with you guys. I went to a show on Jamaica Avenue. I met Jason, and he was like, sign up on my list. And I said, let's try. So, well, like less than a month, I get a call. Then, we started a bid for the job, and we actually win the bid. And then I asked the guy, how do you find us? And the guy said, do you know Jason? I said, Jason. And I said, oh yes, and I get a nice contract.
So we've been fairly successful in facilitating some opportunities for some of our members, but when we talk about structural impediments to executing those opportunities, it boils down to not having access to working capital. And two primary issues with not having access to working capital is, can you fund your payrolls? And can you pay your suppliers on time? And the really interesting thing is that these pain points are aligned with a lot of our strategic partners, the prime contractors and the developers and the construction managers that we work with. So when we conducted kind of surveys amongst them, it was the same issues. They would say things like, Ken, we would love to work with more MWBE firms, but there are concerns with kind of risk management when it comes to awarding these contracts. Can they fund their payrolls, and can they pay their suppliers on time? And a lot of contractors would tell us, Ken, we award a contract, we come to find out they're not paying the suppliers put a lien on our jobs. So going forward, it makes us far more cautious in how we award contracts and more rigorous in the vetting process. And that's really important for us because it's not just about awarding contracts. We could facilitate as many opportunities as possible for our members, but if we're not assisting in capacity building and putting you in positions where you can access that working capital to pay your workers and pay your suppliers on a timely basis, it doesn't make that much sense, and we're really putting you in a position to fail. And again, it's not to denigrate other agencies or other organizations, but we felt that that was really important because our credibility rests on two ends. It's being credible enough that you believe, as being a member of this organization, we are going to put you in the best position to secure contracts. But then on the other end, on the back end, it's providing vetted, qualified MWBEs for our strategic partners. So we're in a very interesting position in the middle as a facilitator and saying, all right, well, we can provide opportunities for you and put you in the best position possible to execute those opportunities, and we can provide vetted and qualified members, or vetted and qualified MWBEs for our strategic partners. And I think that was really critical in getting a sense of really what the main issues were. And it took about 6 months for us to really pin it down, and we felt like this was probably the most critical workshop that we could conduct. And saying, all right, well, how can we find our way through the challenges and the struggles, and really, and again, every contractor is at a different level. So some contractors are far more sophisticated than others, and again, it's not to besmirch anyone. It's just the reality. Some are more sophisticated than others. Some don't necessarily need to understand the distinctions between a balance sheet and an income statement, but some do. And our goal is, instead of trying to create a workshop where we're targeting some of our members that don't have that level of sophistication when it comes to small business operations and finance, we wanted to get everyone in the room and really walk through this process, because it's really difficult to secure a loan if you don't have the appropriate financial records. More importantly, if you don't understand the distinctions, again, between a cash flow statement, an income statement, a balance sheet. And if you're in front of a lender and they are conducting their risk analysis, you do come up highly problematic. And so for us, it's walking through that process, really getting you to understand on a granular level why these documents are important, and then being able to secure these documents, present these documents to lenders so that you do have access to working capital so that you can fund your payrolls, pay your suppliers, and it puts you in the best position to be awarded a contract from a prime contractor or general contractor. And that's our issue. Our issue is, and our goal, our mission is really to eliminate as many excuses as possible from our strategic partners. Because we do hear them. Our partners willing to work with MWBEs, but this, but that, but this, but that. So for us, we're saying, okay, we recognize your pain points. Let's remove these barriers. Let's remove these impediments. Let's eliminate these excuses so that you are in the best position to not only be awarded a contract, but to execute these contracts. And again, the biggest pain points are access to working capital. If you can't take a $500,000 contract if you know you have to pay your workers on a weekly basis, but you're not going to get paid until 6 weeks out. Can you front your payroll for 6 weeks? And we found that a lot of smaller contractors can't. And many go out of business, or many become reluctant to bid on larger contracts. And so what is the goal of being an MBE or WBE firm? It's really to grow your firms, to grow, to increase your capacity. And part and parcel of this is really understanding on many levels how to build that capacity. These are not just empty words, at least for us it's not. This is something that we believe in because we want to see our members grow and provide testimonies and say like, look, I went from grossing $500,000 a year to grossing $5 million a year. And now I'm in a position to award contracts to other MBEs and other WBEs. And now I'm a prime contractor and I'm a developer. That's ultimately our goal, and that's really the push that we're trying to do. But you can't really achieve that until you develop a certain level of sophistication. And again, this is not for everyone. And some people are already at that level, but some aren't. And we're here really just to provide resources. And so we have a panel of industry stakeholders. These are people that work in the trenches. They are allies, they are strategic partners to the organization, and we hope that you can leverage these relationships to expand your companies. And so we have George Arjun. So he's representing mega contracting. So this is a prime contractor. They do a ton of affordable housing throughout the city. He's going to walk through the pain points that they've identified as a firm when it comes to awarding contracts to subcontractors in general, and MBE and WBE subcontractors in particular. And I think that's really helpful because it'll provide that ground level insight that oftentimes MBEs aren't privy to. And that's what we found. There is this disconnect when it comes to communication between an MBE or WBE and a prime contractor. And there's this mutual cynicism and trying to understand why can't I get a contract? How come I can't get access to this firm's book of business? And so here we have a contractor, really, he'll be able to walk through the process and say, look, these are the challenges that we encounter. And I think, or at least I hope, that you can walk away with more insight in terms of, all right, we understand why they would be reluctant to award a contract to maybe my company because we aren't in a position to, say, provide the necessary financials. And maybe we don't understand what subcontractor default insurance is, and we don't understand what the necessary paperwork that they need to facilitate that process. And so hopefully you can walk away with key insight in that sense. Now we have Bill Hughes. He's a partner from accounting and auditing firm, business consulting firm, Grassi & Co. to really walk through the various relevant financial documents that small businesses need. Again, I mentioned a few of them: the income statement, the balance sheet, the cash flow statement. And we think that's a really important piece because, again, not everyone in the room, but some in the room think can need some additional guidance to really understand why this is important. Because many moons ago, I represented prime contractors in a different capacity, and that was a big issue for them. They would say, Ken, we're looking to work with more MBEs and more WBEs, and this is actually a true story. So I approached an MBE, and I said, this prime contractor is looking to, it was a $500,000 contract. So the prime told me talk to this MWBE, get their financials so that we can review them, because we need to see if they have cash to front payroll and pay their suppliers. So I approached this MWBE and I said, look, I have a contract lined up for you. I just need to see a balance sheet. Their response was, what's a balance sheet? And that's a problem, and that's the critical issue there. It's saying, all right, clearly they have a business, they've been relatively successful, but their lack of sophistication has prevented them from being awarded this $500,000 contract, which would have helped them build capacity and grow their company. So Bill will be really instrumental in kind of explaining why a mega is looking for your balance sheet and wants to review your balance sheet. And it's not to pry, it's just to assess if you are a worthwhile risk to take. So I think so Bill will be really important. And we have Nancy Karen, who represents Bach Capital. So she is where the rubber meets the road when it comes to access and working capital. This is an individual who will walk through the process, the underwriting process for all of you, if you're looking to source working capital, so that you can execute that contract that hopefully we can facilitate for you. So I think that'll be really instrumental. And last but not least, you have Nat from Market Lending Association. So he represents an association of alternative lenders, small business lenders, and he'll really provide a broad overview of kind of what you need as small enterprises, as growing enterprises to scale and increase your capacity. And I think, and I hope that Nat can really touch on the distinctions between the business enterprises that he represents and your conventional lenders like the JP Morgan Chases and the Citibanks, and understand why it's so difficult for you to access a loan from a Citibank, from a JP Morgan, from a Wells Fargo. So this is the panel. We'll start with George.
All right, well, I'd like to start off by thanking Ken, Jason, and Columbia for hosting, and very nice to meet you all. I hope to meet you individually after this conversation. And I think you did a great job of touching upon some of the challenges that we see when we hire new contractors. So to take you through the process about when we hire a new contractor, somebody that comes to us can say, we want to bid on your work. The first thing we'll ask them to do is fill out a subcontractor qualification form. You know, we want to know what projects you've done, what your workforce is, what type of work you do. We'll ask you for your financial statements. We'll ask for insurance. That's a very big key because there are a lot of requirements on the insurance. It's getting increasingly complicated to build in New York City. There's a lot of requirements from the owner on what insurance you have to carry, and then our insurance carriers will also request for our subcontractors to have specific limits and other things in their policies. So it's very important to work with a good broker who's not selling you a phony policy, but a policy that'll hold water. And it's very important not to bind the policy before the contractor has reviewed it, because they need to review it and say this is approvable and you're able to work on our project. I've seen it countless times where somebody binds a policy and brings it to us and it's not worth the piece of paper that it's written on. And they have to go back to their insurance broker and pay more money to get this. Another thing Ken touched on is capital. It's probably about 8 to 9 weeks of payroll that you have to front before you get your first payment on a job, because you do a month's worth of work, then you requisition for it, the payment comes in a month later. So you have to be able to have the money not only to front for your payroll, suppliers, heat, water, and electricity in your offices. There's a lot of things that you need to be paying while you're doing your first month of work, first 2 months of work that you need to support. Again, financial statements, the balance sheet will also tell us that story. It'll tell us how much cash you have. It'll tell us your capital, and then we'll also ask for references. We'll ask for other contractors that you've worked with. We'll ask to speak to your vendors. We'll ask to speak to your lenders, or if you have a line of credit, to who provides that line of credit. So we'll call GCs or other contractors that you've done work for and ask how their work was. And it's a very small community, the affordable housing community, so you're as good as your last project. You need to take every contract very seriously. You need to follow through on all the requirements that the contracts have. And because we will be calling those contractors and asking, how was this person on this job? And if you were a headache, they'll say that you're a headache. But if you were a good contractor and you did everything that you said that you were going to do, then that'll make it a lot more comfortable to hire a company like that. Speaking to suppliers, basically we want to see, have you ever had to lien a job because of this? A lien is a very big issue when you're a contractor. Owners won't pay if there's a lien on the job, so it's very important that we assess what risk somebody might pose to us before hiring them. And then lastly, something that's very important is having a bookkeeper or an office manager in the office. I call us the mega contracting and paperwork company now because with all the agencies that we work with, there's a lot of paperwork that goes along with it. On prevailing wage jobs, it's a tremendous amount of paperwork. There's weekly certified payroll reports. You have to provide canceled checks. There's a lot there. But even on non-prevailing wage jobs now, if HPD has funded any part of the projects, and at least the work we do, HPD has funded all of the projects, every quarter you have to report what your payroll was for that quarter. So there's a lot of bookkeeping work that needs to get done, and we need to be assured that there's somebody that's going to handle this work. So that's really the two main challenges that we see when we're onboarding new subcontractors. And the most important thing is when something's requested, for example, like my example is the subcontractor qualification form, but other contractors out there, they'll have certain things that they want before they hire you. Be responsive, call the contractor, find out if there's anything that you're missing. You know, it really helps a lot when we see how much you're pushing to get this job. Because if you're pushing to get this job, we know you'll push to get the job done. And that's the concern, the main concern that we have is that if we give somebody that we haven't worked with before a job, are they going to take it from A to Z like we'd like? And the more you can prove that to us beforehand, the easier it is for us to onboard you.
Bill?
How are you, everyone? Good evening. I'm Bill Hughes. I'm a partner with Grassi and Company CPAs here in New York. Our main office is actually out in Long Island. We have a New York City office, and I actually work out of our New Jersey office. Try not to bore everyone with a lot of accounting jargon, and we'll try and get through some of this. You've heard a lot of the terms already from Ken and George. The main things, I mean, we'll talk about financial statements, which is a big thing to be able to present that to everyone that you work with. Cash flow management is really a number one concern. These two here were pretty nice when they mentioned 6 weeks out on payroll and 8 weeks out. It's probably more like 12 to 16 weeks, unfortunately, with some of the contractors and owners that you're dealing with out there. You know, and sometimes some of these contracts, you're getting them done in 16 weeks, and you haven't even seen a nickel back. So that's a lot of consideration, and it's a lot to really think about. Income tax considerations, I won't get too crazy into there, but there's a lot of specialty tax rules out there for contractors, and they can be very advantageous to help you manage your cash flow and defer taxes out into the future. You're a CPA, I'm going to talk about, you only really want to hire Grassi, but and then we'll have questions. Today's objectives, you know, we've kind of been talking about some of that. Contractors' financial statements. You know, the first thing you really need to have is a balance sheet. It's one thing we've kind of, you know, we've started out talking. You need to be able to put a balance sheet which are all your company's assets. So that includes your cash, accounts receivable, any of your fixed assets if you happen to have equipment. You know, a lot of contractors, you know, they're out there buying equipment, or you have transportation equipment or backhoes, that type of stuff. Depends what you're in. You know, your balance sheet also though includes your liabilities. So, you know, your liabilities, your accounts payable, any of your payroll taxes, any debt you may have. You know, you may incur some debt to buy some of this equipment. You may have lines of credit as well. So you're looking at all your total assets, less your liabilities equals your net equity. So that's a lot of what George is looking at and his company is looking at, to make sure that you have the wherewithal to, you know, to proceed on a job and be able to get out there and have the cash flow. You know, if you're going to have to spend $50,000 a week on payroll, or even $20,000 a week, they want to be sure that you can manage all of that. Progress, you know, income and expenses, that's a profit and loss statement. It's basically just your revenues on any of your job revenues, less your expenses. As far as your expenses go, you have direct expenses, which are job related. You know, you're direct if you have, you know, direct payroll on your jobs. You have all the fringes associated with all of that direct payroll. Today's day and age, insurance expense is huge. You know, any contractor out there right now, you're running into workers' comp and general liability rates are going through the roof. They are probably the number one thing. If you have $1 of payroll, even if you're a non-union contractor, you probably have 75 cents per dollar of payroll that you're paying out in fringes, which are payroll, taxes, and all your insurance benefits, any other benefits. If you're a union contractor, that number's more like, you know, $1.25 to $1.50 per $1 labor dollar. So that's where you kind of see all the overhead is really coming in on that. You know, and then you have what I call your below the line costs. You have your, you know, job revenue, less your cost, so direct costs associated with that. Then you have your indirect costs associated with jobs, might be project managers, your estimating department. And then you have your office overhead, you know, which may be your rent for your office. You have your office staff, you know, hopefully it's lean and mean, but you know, that stuff you have to look at. There's a lot of, you know, just your G&A, as they call them, general administrative expenses. Cash flows, you know, all of these things are contained in a general financial statement on the board. You know, there's a bunch of different levels of financial statement you can do. Typically, smaller contractors are getting what they call the compiled or review level financial statement. You're typically not getting audited financial statements. Usually, if you're doing north of 25 million, you may run into happen to have an audited financial statement. So you're usually talking about a lower level financial statement. But cash flows, you know, the number one thing for contractors, even large contractors, and that's your operating cash. You know, cash flow, which is basically your accounts receivable less all your liabilities. That's basically, you know, your cash intake less your cash outflow, and that's, you know, not counting any capital transactions or debt transactions. You know, so that's saying that you're taking in enough money to pay all your current bills and you have some cash left over. Actual job profits and estimated job profits. Typically, any users of your financial statements want to see your ability to estimate your contracts. And they want to know that if you have a $250,000 contract and you say you're going to make $50,000 on it, you know, that's a 20% gross profit, they want to see that you're going to hit those. You know, so that's an estimate. That's on a job in progress. You know, when you complete those jobs, they want to see that you're in the ballpark. You know, that you're coming in around 20%. They don't want to see you coming in at 40%. They also don't want to see you coming in at 10% because they're kind of looking at it and saying, wait a minute, if he can blow it that it's 40% versus his original estimate at 20, he can go just as far south. So that's something that you gotta keep in mind. They want to understand that you can estimate your jobs and do it right, because that impacts everything else here. Cash flow, you know, if you blow an estimate, where's the money coming from? You know, that becomes a big thing. We kind of talked about this basic accounting question, you know, assets, less your liabilities, leave you with equity. Won't bore you with all that stuff. Accrual accounting, that's the primary thing you're doing with financial statements. You know, they're on a percentage of completion is something you'll eventually pick up on, but accrual accounting is you're recognizing your receivables as of when the work is completed. So if you're doing work as of, you know, August 30th, let's say, but you didn't send out the bill until today, it's still work that you should be accruing for, and you recognize the revenue as of August 31st because you did it in the prior month. The same with payables. Just because the payable bill came in today, but you got the goods 3 weeks ago, you actually owed the money 3 weeks ago. So that's really just all the accrual accounting, and you want to do matching.
Okay. Can you take us a few moments just to compare and contrast accrual versus cash accounting, cash basis accounting? So I'm assuming maybe some of our members might be using cash basis accounting.
Yeah, I mean, as far as cash basis goes, cash is, you know, as you collect it, you're recognizing it. And as you're spending it, you're recognizing the expenses. So that's really the difference between cash and accrual. Accrual is actually as you're earning it, you're recording it. You may not have received it. So that's accrual accounting versus cash. Cash is just what came in, you record, what went out, you record. Most people don't recognize it for financial statement reporting. Any of the users you're speaking to, they don't want to know about cash basis. They want to know what your accrual statements look at, because you could have a drawer full of bills sitting there that you haven't recorded, so you can make anything look pretty good on a cash basis. Typically for tax, a lot of smaller contractors will use cash basis. You can have two different methods. And that's kind of important in construction, especially with smaller contractors. Like I said, there's a lot of tax advantages to construction contractors to defer income that you may recognize on an accrual basis or a percentage of completion basis. You know, the whole idea in the tax world is to defer and push out as much income as you can. You'll kind of learn that as you go along when your accountant comes and says, well, you owe $100,000 this week. Then you usually start learning pretty quickly what the difference is between accrual and cash, so you start to understand a lot of the differences. We just had a deadline yesterday, you know, for corporate and business tax returns, so we have a lot of these conversations with some of our business owners. Percentage of completion method, I won't really bore you with some of the details on it, but basically on a job by job basis, you know, we calculate jobs in progress or percentage of completion on those jobs. Percentage of completion is based upon your costs, meaning whatever cost you've incurred to date on any contract versus your total estimate cost. So as an example, if you have a $500,000 contract and you've estimated the cost at $400,000 that it's going to cost you by the end of the job, and if you've incurred $200,000 of actual costs through today, you're 50% complete. It's the 200,000 divided by the 400,000 puts you at 50% complete. So theoretically, if you're 50% complete, you should have billed half of the $500,000 contract. Now, there's a calculation in accounting, you know, if you're overbilled or underbilled based upon that, but it's really the cost versus your estimate that you have to kind of concern yourself with. And that's the whole nuts and bolts of the construction contractor to begin with. You know, you want to know that you're estimating your jobs and you're hitting those numbers. You know, there's reasons why you may not. You know, there are contract problems. Some contracts, you know, get extended, delayed. You know, you may run over in cost, but at least that stuff is manageable. Stuff's also manageable that you could go back potentially to the owner and get a change order for all that stuff. So that comes back to a lot of your accounting and understanding what's going on, because if you don't document, keep good records, you're going to shoot yourself in the foot down the road to begin with. I can make this available, Terry, but this goes through the calculation kind of what I was just telling. We'll try and bore you with all this accounting. We are a little bit geeky as accountants, you know, we like to get into all that stuff. You know, and what makes a contractor's financial statement unique? Usually presentation. One of the biggest problems we see, and we get called in as a CPA firm, you know, we have a lot of contacts, a lot of insurance, surety people, bonding people, GCs, CMs, lenders across the board. They will typically bring us in when they get a bad product. There's a lot of accountants out there who don't necessarily understand the construction industry, and they don't do a good job on financial statements. So often I'll get called by a banker. He'll say, I got this statement the other day, the thing's horrendous. We're recommending you to this contract. You know, so that's how we get a lot of business. It's a lot of word of mouth, and, you know, we as a firm, you know, we understand the construction industry. And don't get me wrong, there's a lot of good smaller accountants out there who, you know, understand contractors, but be sure your accountant understands what's going on in your world. Because if he doesn't, and he makes a bad presentation to one of these lenders, you know, that's not helping. And, you know, so you want to make sure they know what they're doing. There's a certain format to financial statements. Typically lenders, bankers, GCs, they know a good product from a bad product. And if they see a bad product, they lose confidence in it very quickly. Like if they see, you know, I can tell you stories all night about financial statements I've seen. Some of them have been just horrendous. Like they're almost made up. You know, and a lot of that is, you know, their accountant doesn't understand the industry, and also, you know, some of you guys as contractors, you're not getting the right advice and you're not getting the right direction on things. You know, it may cost a little bit extra sometimes to get a better product, but in the long run, you're much better off, you know, but it's, you know, you gotta just learn what's right out there. Cash flow management, there wasn't, oh, there it is. Cash is king. It is numero uno on all of your lists, any contractor's list. You know, we've got a huge GC CM here. You know, they need cash just as much. You know, they've got weekly payroll just like everybody else does. You know, cash drives the whole business. You know, it helps your current operating. It helps you sustain 12, 16 weeks on jobs. You know, you've got to look out. You know, I tell a lot of my contractors, you got to look at least 6 months, and that's just a short term to understand your short term needs, and then they can look out, you know, on a 2 or 3 year period. It's not quite that simple, you know, making it sound easier, but you know where some of your work is going to come from, and you know you can kind of plan a little bit behind some of that stuff. You know, the objectives in cash flow, the biggest problem we see, accounts receivable collections. You know, if you have money on the street, it's hurting you. And you have to understand where all your aged accounts receivable are, you know, who are your problem collections, who do you have to continue to push, you know, because if your money starts getting 60, 90 days old, it's impacting you every day on just making your payroll, paying all your just, you know, your normal operating bills on a regular basis. So, you know, that's the biggest thing we push. We always assess receivables. We go through receivables with our owners, you know, to find out where problem areas are. And, you know, you gotta stay on. And the last person who's typically on a call is the owner. Like my own receivables, I mean, I have a problem with receivables just like anybody else does in the accounting business. You know, we people don't pay us. And, you know, sometimes I have to pick up the phone and, you know, I gotta say, hey, we can't do any more work. You know, a little bit easier for me to do that than it is for you guys with some of your contracts. You know, you just can't say, I'm not showing up tomorrow. You gotta be clear on what a lot of your contract terms say. You know, this just goes back, collection versus disbursement, money you're bringing in, money that's going out, days outstanding, you gotta look at your receivables, gotta understand those. I say establish a policy, it's, you know, you gotta get into, you know, whether it's Tuesdays, we're gonna call all of our customers, you know, just try and collect receivables, even ones that are 20 days old, because typically you should be getting paid, you know, on a 30-day cycle, which we could all hope for. You know, you always hear this tie in paying into your subcontractor. You get paid when I get paid. You know, that's the famous CCM line. Income tax consideration, I'll just touch this quickly. The Trump tax rules changed the handling for contractors. If you average under $25 million a year of revenue over a 3-year period, you have a lot of flexibility in tax reporting. You can do it on a cash basis, you know, which you only recognize income when you collect it. You can do it on a completed contract basis. You only recognize the income on a contract once it's fully completed. So, you know, that gives you a little bit of flexibility, you know, as to when you finally complete a job. You know, so it gives you a little bit of, you know, if you're over the $25 million average, you have to report tax on a percentage of completion. But, you know, I mentioned here, all of these rules are governed under the IRS Section 460. It's if you want to go to sleep quickly, just pick it up, start reading it, you'll be gone. Because it puts me to sleep. But it's pretty extensive, and we're pretty good at it, our tax guys. That was the smaller contractor exception I was just talking about. You know, again, these are just some of the methods. You know, it could be certainly advantageous, and they've set up the rules on purpose to help contractors. They want to help you to get started, get into business, and be able to, you know, save some dollars on the tax, you know, till the end. It gets deferred. You always end up paying the tax, just want to pay it about 10 years from now. Finding the right CPA firm, you know, again, you know, we're pretty well known in the industry as a firm in the New York metropolitan area. Because like I said, there's a lot of good small accountants out there who understand contractors. They deal with a lot of the bonding companies, sureties, you know, insurance brokers in the industry and bankers. I'll tell you, on banking, you know, we would love to say if you go to Chase, Wells Fargo, they're not big lenders to the construction industry. There are certain lenders that do cater to the construction industry and work with them. You know, like M&T sometimes is good. A lot of the second level banks typically work better with contractors.
Next up is Nancy Carey. So Nancy is a lifeline when it comes to accessing working capital. And so we'll have her kind of walk through what the underwriting process is and really explain the distinctions between some of the top tier banking lenders and why they view this as too much of a niche market to really consider MWBE subcontractors as credible borrowers.
Hi, everybody. I don't think this is so boring. I'm Nancy Karen. I'm the Executive Director of Business Outreach Center Network and BOC Capital Corp. The whole reason for BOC Capital Corp was because we had business owners who had new opportunities, and the opportunities required capital, and there was no place for them to get enough capital to make those opportunities work for them. So, so we created a loan program, and we started with that product. So it's been over a decade now, and we are one of the contract financing lenders in the city's contract finance loan program. We're a small business lender under Empire State Development's lending program, and we really pride ourselves on working with contractors quite a bit. We're even trying to make sure that the folks at the affordable housing developers, GCs, CMs, understand that if someone walks in and say, I have bought Capital Corp by my side, that means they have capital available for that project. And that's a really big deal, and we're just, plodding away CM, GC by GC to make sure people understand this, because when they do, all of a sudden a contractor whose balance sheet today doesn't look strong, they understand the money's there for them. And it's like having a line of credit that can support that project. So it's working, and it doesn't always work. There's, construction is a wacky world out there, and whoever you're subcontracting for, that's a risky proposition. You have to really check them out and their reputation, and things happen. But I'm not trying to be negative. Okay, so I explained that we are a nonprofit lender called the CDFI, and our big focus is lending to minority, immigrant, and women-owned businesses, and focus in low, moderate income neighborhoods. We actually lend from $1,000 to $500,000, but anything over $50,000 would be a contract-based loan product, and anything over $250,000 would be a contract-based loan product for a city project. Some city government agency funded the project. Now, if, for instance, a city agency funded an affordable housing project, we can stretch the definition even though it's not a city agency doing the project. So, the catch is that we really do require an assignment of payment in order to get the loan, because our experience has shown in the past that contractors are very optimistic, as are all entrepreneurs, and they'll redesign what the capital is for if we give them the opportunity to do that. Oh, well, I finished this project, but now I just rolled over your loan that was supposed to be for this project, well, now it's working on that project. I didn't bother to tell you that. So, so that happened to us a few times, and that's not the model for a contract-based loan. It's supposed to be tied to the project, and therefore we work with the prime contractor, the city agency, the institution like Columbia, the affordable housing developer, whoever it may be, to set up some type of two-party check and assignment of payment and all kinds of innovative ways to make this work. We're very flexible and innovative in order to help smaller contractors get the capital they need, since we pretty well know that there aren't too many places to do that. So that's our goal. We talked about all of that. Our typical contract-based loans are 3 to 12 months, but we usually just book them at 12 months because things get delayed, and we would rather not have to redefine the loan terms midway. So we'll start out with a 12-month, even if you think you're going to get paid and everything's going to be beautiful in 3 months. That'll be great, but if it doesn't happen as fast as you expect it to, we can work with a longer term as well. When it comes to city-owned projects, the city is paying most of the interest for the contractors through their contract finance loan fund model. And so we're charging a contractor 3% annual interest rate, which is 0.25% per month, which is unheard of. These are really high-risk loans, and it's 0.25% a month. Very, very, very affordable. Our normal rate is 0.88% a month, less than 1%, 10% a year, which is also, in the world of this type of lending, very affordable. So we're here to make it work. Our model, and I have this on paper, I don't have to get into this in great depth. Some of you've experienced it yourselves. It's not easy, but it's not harder than getting pre-qualified with an affordable housing developer, with a CM, with a GC. We all really want you to be able to succeed. The worst thing that happens to a lender like us, who are mission-driven, we're really not covering our costs from your revenue to us. We have other sources to supplement your revenue to us. We don't want our loan to hurt your business. And believe it or not, there have been people who come to me and begged and cried and said, I've got behind in my rent, but can't you help me with a loan? I'll be back in business, everything will be great. And, kind of the heartstrings started pulling, and I had the boss made the loan, and lo and behold, 2 months later, business is out of business. They owe more money than they would have owed 2 months before. They're in worse shape with their credit, and our loan didn't help them one bit. That was the intention to help, but it didn't help. So why do we go through this process? Is so that we kind of know that our loan's going to help you succeed. We actually, when it comes to construction, we will look at your estimate, we'll look at the specs. We have someone who's expert in all of that. We needed someone who's expert in that in order to make these kind of loans. And they're going to ask you some of the same questions that you might get asked at a de-scoping meeting to make sure you covered all your costs. I mean, do you know that if you're on a big project, all your guys making their $100 an hour are going to spend hours and hours sitting in safety meetings, orientations? You should factor that into your estimate. And there's so many other things. Do you know that on a prevailing wage rate, unlike a union, if the benefits are going to the employee, you're paying taxes on those, payroll taxes. So the fact of the matter is, there might be hidden costs that you hadn't factored in, and we really feel responsible not to let that go by without us asking some of those questions up front and helping you clarify whether you got your estimates straight. Because, George would rather have you show up and even have won the bid and say, I made a mistake, as opposed to get into the job and stop. Right, George?
Yes.
You would. And because that's what the CMs and GCs are telling us. I know it's scary, you win a bid and you're the low bidder, and all of a sudden you feel that you will lose your reputation and you will never get another job if you don't just go through with it. But the GCs and CMs and developers, they don't want you to step up and start something that you aren't confident about finishing. They really don't. And if you can be honest and communicate, responsibly, that's really advice I've heard from them. So I'm sharing with you. I was asked to talk about underwriting. So I made a whole presentation for you about underwriting. And it's general. And if I have time, I'll go through it. But if I don't have time, I'll just hand it to you. But just to give you, should I keep going?
Yeah.
A little overview. Underwriting is the process any lender, loan provider, or online lender takes to review your application and determine the risk, for lending you that money. And they look at your credit reports, they do background checks, they look at tax returns, bank statements, personal financial statements, business ownership, contracts, all of this kind of stuff, business planning sometimes, stated uses of funds, financial projections. Some of these things were already covered in what's incorporated into a financial statement, some are not. Financial projections, the lender's really interested in how you project your cash flow to go. The stated uses of funds, the lender's really interested in what you're spending the funds for. What is your payroll going to be month by month? Is it all going to happen? Is the job going to happen all in 1 month, or is it going to take 12 months? $1 million over 12 months is a much less cash flow burden than $1 million in 1 month. So all of that is really critical. I'm going really zooming through underwriting. So what does a lender learn from your credit report and your background check? They learn all this stuff, and they learn about your character. We're going to kind of, touch on the 5 C's of lending quickly as we jump through underwriting. Your credit history shows how you managed loans and relationships in the past, and that demonstrates character to many lenders and your overall credit worthiness. Some lenders like us don't look at a credit score so much as the content of your credit history and see if you have other responsibilities with other lenders and things like that, and we can make exceptions if you're ready for the contract. What lenders learn from your financial statements, your debt schedules, your returns, your bank statements, and your cash flow projections, they learn about how much capital you have to invest, and that's what these gentlemen were talking about. We need cash. And they learn about your capacity to repay the loan. So if your income and your revenue from the contract is going to be enough to cover the cost of the loan, or if you're doing a term loan, if your normal available profit at the end of each month is enough to cover that month's loan payment. That's called capacity. And everyone wants to see skin in the game. We have contractors come to us, and it's like, wow, I got my $500,000 contract, and I'm going to need, $150,000 to mobilize, and can I borrow the $150,000? It's like, but who's doing the contract now? Is it us or is it you? I mean, who cares whether it works? So sometimes, and on occasion, we do lend that $150,000. The contractors otherwise extended on other contracts. We get to know them well. We believe in them. But typically, we'd like them to have some skin in the game. One of the biggest issues, though, has been mentioned about the insurance. And if a contractor wins a bid, but they didn't go to their broker first and get the proper insurance estimate and build it into the estimate, chances are they could be $80,000 or a lot more off in their estimate, and that could really hurt them. What lenders learn from your ownership information, from your business plan, from your history of business credit, from your accounts receivable that we were talking about earlier, and accounts payable aging schedules. They learn about your structure and your ability to manage your costs and your ability to manage your collections. And this also demonstrates character and also your understanding of your market conditions. So, all of these numbers talk to the lender. All of these reports talk to the lender and tell them about you and your management of your business. And also, you know, in terms of financials just being wrong, it happens all the time. You have somebody putting in information into your accounting system, you got a loan for $50,000 and they put it in as revenue. A loan is not revenue. It happens to be cash, but it's not revenue. Revenue is what you earn from doing what you do. A loan is money, but it's a liability, it's debt. So this is not unusual. We see it not so often, you know, and we will try to help a business clean up their financial statements, and because a lot of times our businesses aren't getting, you know, formal reviewed financials from an accounting firm. What a lender learns from your stated use of funds, honestly, if you don't know how you're going to use the funds and they just say, we need this amount of money, we say what for, and you can't answer that question, we learn a lot about the way you manage your business. You should be extraordinarily detail-oriented about how that money is going to be deployed. It's like if I handed each of you $1,000 right now, and I gave you 10 seconds, you would probably know what that money was going to go to. A credit card, a kid's birthday party, a trip, a savings account. You would know it. We expect people to know what the funds are going to be used for in great detail. Oh, right? And that is really important to us. And then there's that whole idea of collateral. And believe it or not, collateral is not a big deal in our world because a lot of our borrowers don't have a lot of collateral. But that assignment of payment from the contract is looked at like collateral. It ain't exactly collateral, but it's looked at as if it's collateral. So that creates that extra security that we will get paid because the money's going to come to us, and then you and us will know the money's coming because you're requisitioning. You'll be tracking it. We'll all be tracking it. And when the money shows up, we'll know how much goes to the loan and how much goes right back to you for your business. So we just quickly covered in 5 minutes the 5 C's of credit, and those are character, capital, capacity, collateral, and conditions. And you'll probably learn from my friend at the other end of the table that the 5 C's of credit are not one thing. They're different for every lender, completely different. An online lender never sees your face, never asks you what you're going to use your funds for, never does a lot of things. They still do the 5 C's of credit because they know how much credit card income comes into your bank account every day. They're looking at it through their algorithm. And Nuri knows all about algorithms. So all I can say is we all do this, but we do it in different ways. And we've tried to be a really user-friendly lender who underwrites folks in a way that we can get them the money they need to do these contracts.
And last but certainly not least is Hoops, exactly the practical part. An association, and they'll give a broad view of the market that part.
Sure. So as Nancy just mentioned, over the past 15 years or so, there's been an explosion in online loan available for those that don't want to walk into a bank branch or into a location where Nancy might be located with a bunch of paperwork under their arms, and for those that feel like, hey, look, I'm going to present an honest picture of myself to a lender online, and I hope that I can get an honest interest rate and an estimate for what I might qualify for or not qualify for from a reputable lender. So I kind of want to make a distinction here a little bit between contract financing, which is what Nancy went through, and I think what we kind of have talked about so far, versus just simple business financing, right? So in other words, you are a contractor, but you're also a business, like a flower shop or any business. And so as a business, you may need that extra flexibility of working capital that isn't related to bidding on a specific project, isn't tied to a specific contract coming in where you can show that it's simply to say to, you know, a potential partner, like a general contractor that hey, look, I am, what's the equivalent of, I am bankable, right? I have a line of credit from a reputable financial institution that's made billions of loans. So I have one of our lending partners members, Funding Circle is here, and they do low rate online loans. And so in the context of applying for and thinking about credit for your business, you can be very focused on the contract but possibly that could be to your detriment, again, if you wait with $0 in your bank balance and you say, yeah, but I have this contract that's gonna come in, and now if I could only get a loan now, then I could afford to pay my people and I'll be waiting and be ready to collect my revenue in 6 to 8 weeks. The idea, I think, of business financing is to say whether you're a flower shop or a contractor or anything else, you run a business, and if you can show that you have a well-managed business, you have financials, you pay payroll, you've been profitable, you personally show high character, you have a good credit score, and you're willing to give a guarantee and say, hey, look, yeah, this is my business, but I'm putting my name behind this business, then you can also get financing online, not from a bank, but from an online lender that's reputable. And I'll talk a little bit about the difference between some of the abusive online loan products versus some of the products that our members offer. But you can get that kind of credit so that when you approach your next project, or you're actually sitting there with a line of credit from a lender that says, look, I'm ready to make my first month. I have $100,000, $500,000, $1 million, or $25,000, however large or small your sort of needs are. You can show that line of credit at a reasonable interest rate where you can say, hey, look, I can make my monthly, this is a fixed term loan maybe, I can make my monthly payments, or maybe it's more of a revolving type product where it's a line of credit and you might draw it down and then you wouldn't have the full capacity, the full amount. So there are many different products out there. I think the key, and Nancy hit on one, is first thing when you're looking to access financing is, am I being told what the annual percentage rate is? Is there an APR so I can compare one type of financial product to another? Because if you're not, and somebody's saying, I'd like to give you a loan for your business and I'm going to take 4% of your revenue out of their till, then you could be paying 400% interest, because they're just capturing a percentage wherever your revenue is based on willingness to extend you a cash advance, essentially. And so those products can lead to cycle of debt, just like a payday loan, situation in a consumer context. And so I think the idea is reputable lenders today will give you a rate that's not just a simple interest rate. They will give you an annual rate or an annual percentage rate, which includes the fees. And so you can say, hey, look, Funding Circle, Nancy's product is a 10% annual rate. Funding Circle's product is a 12% annual rate. All things being equal, I'd love to have Nancy's product, but maybe what I need is a 12% or an 8% or whatever, but it's an annual rate, so I know on a cost per basis I'm not being absolutely screwed, right? So that's number one, I think, is a key point to think about when you think about financing your business. And I think all the things that people have stressed about having all of your ducks in a row and doing, working with your accounting for a reputable firm. I mean, if you do that, then all of a sudden you're not going to be caught short turning to an abusive lender where you're going to be paying through the nose to just be able to keep your doors open, right? And so it's like not being, penny wise and pound foolish. You work with a really good, sort of CPA that has your you have all your ducks in a row, and you work with, reputable people, and you walk in and you've got your income statement, you've got your balance sheet, you've got your cash flow statement, you really understand how your business works, then you're going to get the lower interest rate loan compared to some of the financial products that are out there if you're ever, in sort of in need. And so I think it's a lot about planning ahead. The internet, the nice part about it is that we talk a lot about why are you, Nat, and the Marketplace Lending Association, why are you finding that you're inclusive? Like, what do you mean by you say you're inclusive? And the answer is people feel comfortable and welcome on the internet. I don't know how to say it other than that, but people feel comfortable applying for loans online. And they put a true picture of themselves out there most of the time, and we can find out if you're not, right? Because there's a lot of sources and ways that you can verify whether somebody is who they say they are and they're not a Russian bot. And we can figure out who you are and whether you're telling the truth about your financial situation. And people do that, and then we find out that people are able to access on a relative basis lower cost products than traditionally they might have gotten from credit card companies and so forth. Again, if you're working with a reputable online lender. We at the Marketplace Lending Association take all that stuff seriously. We've been leading this effort for what's known as the Borrow Bill of Rights, to force small business lenders to disclose APR, so that they can't just say the rate on your product is 3%. You find out that was 3% a month, not 3% a year, so forth. So that's like just kind of truth in lending that doesn't exist. There's no truth in lending rules in small business lending the way there is in consumer lending. So all of that is to just say it's still a buyer beware market out there. And I think as you think about the ability to use some of these new tools and to apply for a loan and get funded for a loan within a day or so, which is what's possible at Funding Circle now, you can literally, put in your information, sign the guarantor form, and you can get a loan at a, single digit or low double digit interest rates. Not as cheap as an SBA loan. Might not be as cheap as a loan that you might get at the,
Not going to get it in a day.
Right, but for us, you can get it in a day. And it's also not going to cost you 40, 50, 60% APR, which some of the products out there do. They absolutely, that's what they're getting from you. And so I want to talk a little bit about really quickly about term loans versus some of the shorter term loans. So if you think about your business, if you get a year-long loan at a certain interest rate, that you're going to have to make a payment every month, right? So your business might be lumpy, so you got to be ready that it doesn't matter if my business is lumpy and I'm going to be waiting 3 or 4 months. I need to make a payment next month, but you're breaking it up over a year, so the payment or maybe over 2 years, or maybe over 3 years, the term of the loan, so the monthly payment isn't that high. And you maybe get a better rate that way than if you go to a short-term lender who doesn't disclose APR or is charging, it's only a 3-month loan, but if you look at the fine print, you're getting 60% APR. And if you have to go to that lender 3 or 4 or 5 times, you're getting overcharged over the course of the year by 5x what you could be getting charged if you went to a more reputable lender. And so I don't want to besmirch but there are even some very big name brand online lenders out there that are getting 50 and 60% APR from companies all the time. And now, again, on a one-time basis, maybe that's not so bad. Maybe the company really needed access capital, and they were going to pay it back in 3 months. And if you annualize that rate, that's 60%. But you don't want to use that 3 to 4 or 5 times a year because you're just overpaying for credit compared to what you should be paying. It's just not a good management of your business. So Ted is here with Funding Circle. He can answer questions about what they do. I just wanted to stress that there's contract financing and then there's business financing. And when you're running a business, it can be really helpful to have financing lined up, again, that's at a reasonable APR with a monthly payment that you can make, but where you're sitting on that $100,000 or $200,000 or $300,000 line of credit so that you can make that first month's payroll. The last suggestion I'd have is for MWCDA. I want to get it right. As you think about working with these guys, all the bigger contractors, there may be an ability to ask for some best practices around the receivables. I mean, all of us in part, there are incentives in place for contractors to work with subcontractors that are minority women-owned businesses. And there ought to be some minimum standards for how they treat those companies. They shouldn't be paying them much later than they're paying other contractors. That's abuse. That's a different form of abuse, right? So everybody should be treating, especially in this setting where the goal is inclusion and the goal is to treat people fairly. If the general contractor, if some giant company like Gilbane is, which is a $400 billion enterprise, is stretching out its payments on a tiny company, that's not very fair. And Gilbane's getting a good deal by getting a chance to work with all of you. So it's just important, I think, to make sure that best practices go both ways. Yes, you guys need to have a reputable CPA. Yes, you need to know the difference between balance sheet and cash flow statement and income statement. You have to have your ducks in a row. But contractors need to treat you all, if you do everything right, they need to treat you right too.
Absolutely. And before we open the floor to Q&A, just to echo your points, it's not only about becoming more sophisticated business concerns. It's not only about having access to capital, because I think by and large, the structural impediments to a lot of smaller contractors is being undercapitalized, which prevents you from executing a contract from, say, a mega, which, and this is something that we've encountered over the last 4 or 5 months, is the opportunities come down the pipeline from our strategic partners, but oftentimes our members aren't well capitalized enough to be able to execute these contracts. But to Nat's point, it is incumbent upon the industry, it is incumbent upon an organization such as ours that collectively we apply under pressure that the general contractors do facilitate these contracts in good faith. And so I think that's critical, because it is problematic when you have a mega prime contractor, pardon the pun, stretch out the payment terms for a smaller contractor, and we've seen it, and I think everyone here has seen it. It can bankrupt,
Yeah.
very quickly a smaller contract.
And I want to hit one point. There's also no prepay. So in terms of setting your business up, so that you're not waiting to go get the contract financing from Nancy. See, if you can get that contract financing, that might be the lowest cost. Or might, maybe ours is competitive. But if you have the business financing laid, put together, and then you come into cash, there's no prepayment penalties on these term loans either. So if if you get a year-long loan, and in month 3 or 4, the money's coming in the door, and you have enough money to pay it off immediately, you can get out of that 10% annual rate loan immediately, and you're out of debt. So and that's another type of term that you want to make sure that your financing partner, if you're working with a lender, that they're not going to slam you with some hidden prepayment penalty. If you do have the money after 3 months, or you find a cheaper source of contract financing to replace that normal business financing, that you're not being stuck with, gosh, I didn't know, now I'm going to get hit with a $50,000, on a $1 million loan, get hit with a $50,000 fine. Like, that's not fair.
Right.
So
we love it if someone has a line of credit or a business loan, and then they are growing fast enough to need an extra contract loan on top of that. That's great. There's no contradiction.
yeah.
Right.
So that's the difference. I think that's the difference when you think about it, is the difference between, again, financing for your business as a whole versus the actual contract financing.
Right, which I think is so critical when, again, that speaks to the advocacy component of our organization, and that we're working with elected officials, we're working with agencies to, one, facilitate an environment with more transparency when it comes to loan terms, when it comes to payment schedules, because these components are so critical. And I think hopefully the goal for the panel is to illustrate how interconnected business finances with lending, with the general contractors, because we want to position our members in the best way possible, so that when we follow up with them, we can say, like, look, we have X amount of members that are ready to gainfully bid on these opportunities, and we're confident that they can execute these opportunities, because we've actually turned down a number of our strategic partners in the prime contractor space, not often, but on occasion, when we recognize, look, we just don't currently have the members that can meet the capacity, because maybe they can't service the debt, and maybe they don't understand it, the members, because again, there can sometimes be a disconnect when it comes to understanding, all right, well, if you secure a loan to execute a contract, what is your debt service on a monthly basis, and can you front that debt service? And for us, it puts us in a challenging position, because it would be really easy for us to say, look, as an organization, all we care about is just creating a pipeline for opportunities. And if you bid, great, we can say that that's a success. But our goal is really to approach this more comprehensively, more holistically. So it's not just about coming to you and saying, look, we have an opportunity, but it's also ensuring that you're in the best position to execute that opportunity.
And some of that might be, if you wanted financing for your business as opposed to contract financing, just for the overall business, and you want a line of credit lined up, you might want to go to these guys to fill out the online loan application to help you make sure that you're answering those questions correctly, that you have, that you're developing as you go through the loan application. Nobody expects that everyone knows everything before they fill out every application. You might need advice. And if you get advice, the right advice, as you're filling it out from the association, then you might be in more position to get approved than if you, again, reveal unsophistication. You don't get, that education as you're filling it out, and then all of a sudden you get turned down, and you say, well, look, I would love to be in position to bid on that contract, but I got turned down for my financing before, and now I'm not in a position to do it. So, getting all the ducks in the row right, including potentially getting help from a reputable somebody who can give you advice on financial services as you fill out an application, even from an online lender. Forget going into a bank, from an online lender, you'll probably put yourself in the best possible position.
Absolutely. We welcome you. We invite you to use us as a resource. Follow up with us as much as possible. Sure, many of you speak to Jason on a fairly regular basis. We're here. Our goal is to see your companies expand. Our goal is to place you in jobs and see that the jobs are executed and seen, because we want all of these companies in the room to be the general contractors of tomorrow, to be the developers of tomorrow, to circle back and say, look, we're in a position to facilitate opportunities for the next batch or wave of members. And really, that's the goal. And this is something that we're really committed and dedicated to. And this is why I think we just want to give a round of applause for our panelists that have kind of taken some time out of their day to really provide some critical insight, because this event wouldn't be possible without panelists, it wouldn't be possible without Columbia University's
Construction administration.
Construction
School of
administration,
Professional Studies.
studies. Yeah, it wouldn't be possible without them. It wouldn't be possible without State Senator James Sanders and his chief of staff is over here representing him. So I think all of these pieces had to come into play to really effectuate this event. It's about momentum. I think, so we had our first workshop in May. It was probably about a third of the crowd. We were really kind of getting our bearings, but over the course of the last 4 months, we've already placed a few members on projects. So momentum is really generated. We're looking to continue that, looking to accelerate that, because again, we understand on a very granular level, it's not just about funneling contracts, it's also about ensuring you're executing. That's what part of our mission was, the incubating component, making sure that you're in the best position possible to execute these contracts. So it works kind of hand in hand. Glad for everyone to come out. Now we'll open up the floor to Q&A.